Question 1. An insured purchases a life insurance policy and names her husband as the primary beneficiary and her daughter as the contingent beneficiary. If the insured and her husband are killed simultaneously in an accident, who would receive the death benefit? A. The insured's estate. B. The insured's daughter. C. The insured's husband's estate. D. The insurer would retain the death benefit. Answer: the insured's daughter. In a simultaneous death scenario where primary and contingent beneficiaries are named, the Uniform Simultaneous Death Act, adopted in Georgia, presumes the primary beneficiary died before the insured. This presumption allows the proceeds to be paid directly to the contingent beneficiary, preventing the need for the death benefit to pass through the primary beneficiary's estate and potentially avoiding additional taxes or probate delays. For example, if a husband is the primary beneficiary and a wife is the insured, and they die together, the death benefit goes to the next in line beneficiary, like their daughter, instead of the husband's estate. Always clearly designate primary and contingent beneficiaries to ensure the death benefit is distributed according to the insured's wishes. Question 2. Which of the following is considered a non-forfeiture option in a whole life insurance policy? A. Waiver of premium. B. Extended term. C. Accidental death benefit. D. Cost of living rider. Answer: extended term. Non-forfeiture options are benefits available to the policy owner that protect the cash value accumulated in a whole life policy if the policy lapses due to non-payment of premiums. Extended term is one such option, allowing the policy's cash value to be used as a single premium to purchase a paid-up term insurance policy for the same face amount as the original whole life policy, for as long a period as the cash value will purchase. The other options listed are riders, which are additional benefits that can be added to a policy for an extra premium, not default options for lapsed policies. Think of non-forfeiture options as safety nets for your policy's built-up value. Question 3. Under a group life insurance plan, who typically receives the certificate of insurance? A. The employer, as the policyholder. B. The insurer, for record keeping. C. Each individual employee covered. D. The state's Department of Insurance. Answer: each individual employee covered. In a group life insurance plan, the employer is the policyholder and receives the master policy, which is the contract between the insurer and the group. However, each individual employee covered under the plan receives a certificate of insurance, which serves as proof of their coverage and outlines their benefits under the group policy. This certificate specifies the coverage amount, beneficiaries, and any other relevant terms specific to that individual's coverage. Remember that the certificate provides evidence of participation, while the master policy is the actual contract. Question 4. An insurer's obligation to pay a death benefit is based on which of the following policy components? A. The application. B. The insuring agreement. C. The policy exclusions. D. The conditions. Answer: the insuring agreement. The insuring agreement is the core promise of the insurance policy, explicitly stating the insurer's fundamental obligation to pay a death benefit upon the death of the insured, as long as the death occurs while the policy is in force and is not excluded. It outlines what is covered and under what circumstances. While the application provides information and exclusions define what is not covered, the insuring agreement is the definitive statement of the coverage itself. This section is essentially the heart of the contract, outlining the insurer's primary promise to the policy owner. Question 5. In Georgia, how long is the free look period for a new life insurance policy? A. 5 days. B. 10 days. C. 20 days. D. 30 days. Answer: 10 days. In Georgia, a new life insurance policy typically comes with a free look period, which is a mandatory 10-day period from the date the policy is delivered during which the policy owner can review the policy and return it for a full refund of any premiums paid, no questions asked. This consumer protection allows buyers to examine the contract's terms and conditions before fully committing. For example, if a policy owner decides after reviewing the policy that it doesn't meet their needs, they can return it within these 10 days without penalty. This provision is designed to ensure policy owners are comfortable and confident with their purchase. Question 6. All of the following are typically included in the policy's entire contract except A. The policy itself. B. A copy of the application. C. Any riders or amendments. D. The producer's solicitation materials. Answer: the producer's solicitation materials. The entire contract provision states that the policy document, along with a copy of the original application and any attached riders or amendments, constitutes the complete agreement between the policy owner and the insurer. This provision ensures that all relevant terms are contained within these documents and prevents any external statements or promises, such as a producer's general solicitation materials or oral representations, from altering the contract. This means that if something isn't written in the policy, application, or riders, it's generally not part of the binding agreement. Question 7. Which of the following is true regarding the taxation of the death benefit paid to a beneficiary under a life insurance policy? A. It is always subject to federal income tax. B. It is typically received income tax-free. C. It is taxable only if it exceeds a certain amount. D. It is subject to state income tax in Georgia. Answer: it is typically received income tax-free. The death benefit paid to a named beneficiary under a life insurance policy is generally received free from federal income tax. This is a significant tax advantage of life insurance, as the full face amount is passed on to the beneficiaries without being reduced by income taxes. While there can be exceptions, such as if the policy was transferred for value, for most standard situations, the death benefit is not considered taxable income to the beneficiary. This tax-advantaged payout makes life insurance an effective tool for wealth transfer and financial security for loved ones. Question 8. What is the primary purpose of the incontestability clause in a life insurance policy? A. To allow the insurer to adjust premiums based on health changes. B. To prevent the insured from changing beneficiaries. C. To protect the insurer from policy owner fraud after a certain period. D. To guarantee policy renewability regardless of the insured's health. Answer: to protect the insurer from policy owner fraud after a certain period. The incontestability clause states that after a life insurance policy has been in force for a specific period, typically 2 years in Georgia, the insurer cannot contest the validity of the policy due to misstatements or concealment of material facts on the application, even if they later discover inaccuracies. This clause provides a sense of security for the policy owner, ensuring that the policy will not be voided later due to an innocent or even negligent misrepresentation. For instance, if an insured unintentionally omitted a minor health condition on the application, after 2 years, the insurer generally cannot deny a claim based on that omission. Question 9. A policy owner allows their whole life policy to lapse. Which non-forfeiture option provides the most life insurance coverage? A. Cash surrender value. B. Reduced paid-up insurance. C. Extended term insurance. D. Waiver of premium. Answer: extended term insurance. When a whole life policy lapses, the extended term insurance non-forfeiture option uses the policy's cash value to purchase a new single premium term policy for the same face amount as the original whole life policy, for as long a period as the cash value can support. While reduced paid-up insurance also provides a new paid-up policy, its face amount is lower than the original. Therefore, extended term insurance offers the greatest amount of coverage, even if it's for a limited duration. Think of it as using your built-up savings to buy temporary protection at the highest possible level. Question 10. A policy owner in Georgia wishes to change the beneficiary of their life insurance policy. This action is generally considered A. Collateral assignment. B. Absolute assignment. C. Policy owner right. D. Rider addition. Answer: Policy owner right. Changing a beneficiary is a fundamental right of the policy owner in a life insurance contract, provided the current beneficiary is not irrevocable. The policy owner maintains control over many aspects of the policy, including the ability to designate or change beneficiaries, assign policy ownership, or select settlement options. This flexibility ensures the policy remains aligned with the policy owner's evolving wishes and circumstances. For instance, if an insured gets divorced, they can typically change their beneficiary from their ex-spouse to a new family member without needing the insurer's specific permission beyond notifying them. Question 11. Which rider would provide an additional benefit to the beneficiary if the insured dies as a result of an accident? A. Waiver of premium rider. B. Guaranteed insurability rider. C. Accidental death benefit rider. D. Cost of living rider. Answer: Accidental death benefit rider. The accidental death benefit rider, sometimes called double indemnity, provides an additional sum of money to the beneficiary if the insured's death is directly caused by an accident, often doubling the policy's face amount. This rider is designed to offer enhanced protection against specific, unexpected events. For example, if a policy has a $100,000 face amount and an accidental death benefit rider, the beneficiary might receive $200,000 if the insured dies in a covered accident. This rider specifically addresses the financial impact of an unforeseen accidental fatality. Question 12. A deferred annuity typically begins making payments to the annuitant at what point? A. Immediately after the premium is paid. B. Upon the death of the annuitant. C. At a future date chosen by the annuitant. D. When the annuitant reaches age 65. Answer: At a future date chosen by the annuitant. A deferred annuity is an annuity contract that delays income payments until a future date chosen by the annuitant, which could be years or even decades after the premiums are paid. During the accumulation phase, the funds in the annuity grow tax-deferred. This contrasts with an immediate annuity, which starts paying out almost immediately after the lump sum premium is paid. Deferred annuities are often used for long-term retirement planning, allowing savings to grow over time before conversion into an income stream. Question 13. Which statement accurately describes the tax treatment of premiums paid for individual life insurance policies? A. They are generally tax-deductible for the policy owner. B. They are deductible if paid by an employer. C. They are not tax-deductible for individuals. D. They are deductible as a medical expense. Answer: They are not tax-deductible for individuals. In most cases, premiums paid for individual life insurance policies are not tax-deductible for the policy owner. While the death benefit is typically received income tax-free, the premiums paid to secure that benefit are generally considered a personal expense by the IRS and therefore do not qualify as a tax deduction. This tax treatment is a common characteristic of personal life insurance, distinguishing it from certain business-related insurance premiums that might be deductible under specific circumstances. Remember, the benefit is usually tax-free, but the cost to get it is not tax-deductible. Question 14. An individual who has a life insurance policy and wants to borrow money from the policy's cash value would typically do so through which provision? A. Reinstatement provision. B. Grace period provision. C. Policy loan provision. D. Dividend options. Answer: Policy loan provision. The policy loan provision allows a policy owner to borrow money directly from the accumulated cash value of a permanent life insurance policy. The loan amount, which cannot exceed the cash value, is typically subject to interest, but the policy does not need to be surrendered. If the insured dies with an outstanding loan, the unpaid loan balance and any accrued interest are subtracted from the death benefit paid to the beneficiary. This provision offers a flexible way for policy owners to access their policy's value during their lifetime without terminating the coverage. Question 15. All of the following are considered types of whole life insurance except A. Straight whole life. B. Limited payment whole life. C. Modified whole life. D. Decreasing term life. Answer: decreasing term life. Decreasing term life insurance is a type of term insurance where the face amount decreases over the policy period, commonly used for mortgage protection. In contrast, straight whole life, limited payment whole life, and modified whole life are all variations of whole life insurance, characterized by level premiums, or premiums that adjust in a predictable way for modified whole life, a guaranteed death benefit, and the accumulation of cash value. Whole life policies are designed for lifetime coverage, while term policies provide coverage for a specific period. Question 16. In Georgia, if an insured changes from one life insurance policy to another, what is the producer required to do if the new policy replaces an existing one? A. Only insure the new policy is issued. B. Provide the applicant with a notice regarding replacement and submit it to the replacing insurer. C. Inform the existing insurer of the replacement verbally. D. Obtain the signature of the insurer's CEO on the replacement form. Answer: provide the applicant with a notice regarding replacement and submit it to the replacing insurer. Georgia insurance regulations, like those in many states, have strict requirements for policy replacement to protect consumers from potential disadvantages such as loss of benefits, higher premiums, or new waiting periods. When a producer facilitates the replacement of an existing life insurance policy with a new one, they are generally required to provide the applicant with a notice regarding replacement document and ensure a copy is submitted to the replacing insurer. This form informs the consumer of the potential consequences of replacement and advises them to compare policies carefully. This helps prevent churning, where producers might replace policies unnecessarily to generate new commissions. Question 17. The primary purpose of the Medical Information Bureau, MIB, is to A. Provide medical treatment to insurance applicants. B. Serve as a non-profit trade organization that collects and shares medical information about individuals. C. Process insurance claims related to medical conditions. D. Regulate medical insurance companies. Answer: serve as a non-profit trade organization that collects and shares medical information about individuals. The Medical Information Bureau, MIB, is a non-profit trade organization that receives and stores confidential underwriting information from member insurance companies. Its primary purpose is to help insurers detect and deter fraud by serving as a central database for health information reported by applicants. When an individual applies for insurance, member companies can query the MIB to check for discrepancies or omissions in the application, which helps them assess risk accurately. For example, if an applicant fails to disclose a serious medical condition on their application, the MIB might have a record of it from a previous application to another member insurer. Question 18. Which of the following best describes a policy that pays a benefit only if the insured dies during a specific period, with no cash value accumulation? A. Whole life insurance. B. Universal life insurance. C. Term life insurance. D. Variable life insurance. Answer: term life insurance. Term life insurance is characterized by providing coverage for a specified period, the term, and paying a death benefit only if the insured dies within that term. Unlike permanent policies, it does not accumulate cash value and typically has lower premiums for the same amount of coverage compared to whole life policies. It's often referred to as pure protection because it solely offers a death benefit and no living benefits or savings component. For instance, a 20-year term policy would pay out if the insured dies within those 20 years, but it expires without value if the insured outlives the term. Question 19. A life insurance policy's cash value is guaranteed to grow at a minimum rate, and the policy owner can vary the amount of premium paid. This best describes A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Credit life insurance. Answer: Universal life insurance. Universal life, UL, insurance is a flexible premium, adjustable life insurance policy that offers a guaranteed minimum interest rate on its cash value accumulation and allows the policy owner to vary the amount or timing of premium payments. This flexibility is a key differentiator from traditional whole life, where premiums are fixed. While it has cash value like whole life, its premiums and death benefit can be adjusted to meet changing needs, making it a popular choice for those seeking adaptability in their coverage. Question 20. Which of the following is a characteristic of participating life insurance policies? A. They do not pay dividends to policy owners. B. They are typically issued by stock companies. C. They allow policy owners to share in the insurer's surplus through dividends. D. They have fixed, guaranteed premiums that never change. Answer: They allow policy owners to share in the insurer's surplus through dividends. Participating life insurance policies are typically issued by mutual insurance companies and allow policy owners to share in the company's divisible surplus through the payment of dividends. These dividends are not guaranteed but are distributed if the company's financial performance exceeds expectations, example lower claims, higher investment returns, or lower expenses than projected. Dividends can be used in various ways, such as reducing future premiums, purchasing paid-up additions, or being paid in cash. This distinguishes them from non-participating policies, which do not pay dividends. Question 21. What is the primary purpose of a producer's report in a life insurance application? A. To serve as part of the insured's medical history. B. To document the producer's observations and provide additional information about the applicant. C. To outline the policy's terms and conditions to the applicant. D. To determine the applicant's financial rating for underwriting. Answer: To document the producer's observations and provide additional information about the applicant. The producer's report is a confidential section of a life insurance application completed by the agent, separate from the applicant section. Its primary purpose is to provide the insurer with the producer's personal observations and insights regarding the applicant's character, financial status, and any other information relevant to assessing insurability that may not be captured in the main application questions. For example, if an applicant appears significantly older or frilier than their stated age, the producer might note this in the report. This helps the underwriter gain a more complete picture of the risk. Question 22. Which annuity payout option guarantees payments for the life of the annuitant, but also for a minimum number of years, even if the annuitant dies before that period? A. Pure life annuity. B. Life annuity with period certain. C. Joint and survivor annuity. D. Fixed amount annuity. Answer: Life annuity with period certain. A life annuity with period certain guarantees income payments for the annuitant's entire life, but also for a specified minimum period, example 10 or 20 years, even if the annuitant dies before the end of that period. If the annuitant dies within the guaranteed period, the remaining payments are made to a designated beneficiary. This option provides a balance between maximizing lifetime income and ensuring some protection for beneficiaries if the annuitant dies prematurely. For example, a life 10-year period certain guarantees payments for at least 10 years, even if the annuitant lives longer, but also ensures payments continue to a beneficiary for the remainder of the 10 years if the annuitant dies in year 5. Question 23. An individual applied for a life insurance policy and paid the initial premium. The producer issued a conditional receipt. If the applicant dies before the policy is issued, the death benefit will be paid if A. The policy was approved before the death. B. The applicant was insurable at the time of the application. C. The premium was paid in full. D. The policy was delivered to the applicant. Answer: the applicant was insurable at the time of the application. A conditional receipt provides coverage starting from the date of application or the date of the medical exam, whichever is later, provided the applicant is found to be insurable according to the insurer's underwriting standards as of that earlier date. If the applicant dies during the underwriting process and is later determined to have been insurable at the time of application, the death benefit would be paid. This is a crucial concept, as it offers interim coverage while the insurer processes the application. Think of it as coverage on the condition that you qualify. Question 24. What is the primary purpose of Georgia's Life and Health Insurance Guaranty Association? A. To investigate claims of fraud against insurance companies. B. To protect policy owners, insureds, and beneficiaries against an insurer's insolvency. C. To regulate insurance rates and policy forms in the state. D. To provide direct insurance coverage to Georgia residents. Answer: to protect policy owners, insureds, and beneficiaries against an insurer's insolvency. The Georgia Life and Health Insurance Guaranty Association is a state-mandated organization created to protect policy owners, insureds, and beneficiaries in the event that a member insurance company becomes financially insolvent and cannot meet its obligations. It steps in to pay covered claims and continue coverage, up to certain limits defined by state law. This association acts as a safety net, ensuring that consumers do not lose their insurance coverage or benefits simply because their insurer fails. It's a critical consumer protection mechanism within the insurance industry. Question 25. Which settlement option allows the beneficiary to receive the death benefit in periodic payments of a specific amount until the funds are exhausted? A. Interest only. B. Fixed amount. C. Fixed period. D. Life income. Answer: fixed amount. The fixed amount settlement option allows the beneficiary to choose to receive the death benefit in regular payments of a specific dollar amount, rather than as a lump sum. The payments continue until the principal and any interest earned are completely exhausted. The duration of the payments will depend on the amount chosen and the interest earned. For example, a beneficiary might choose to receive $1,000 per month until the entire death benefit is paid out. This option provides a predictable income stream for the beneficiary, allowing them to manage their finances consistently.